Good evening, everyone, and welcome to the Strategy and Stock Picks Q4 2025. Today's session is on the US market, and you may take a look at the agenda stated in the slides later. We still have some time before the webinar begins, so sit back, relax, and our speaker will begin shortly. Just a gentle reminder to submit your questions in the Q&A section. You may also upvote other participants' questions. Questions with the highest number of votes will be selected by our speaker. Thank you. Okay, without further ado, let's start the webinar. For this session, we have Glenn Tom, Research Manager of Phillip Securities Research, and his team to cover the US market outlook. Let us welcome them, and you may begin.
Hey, hi everyone. Thanks for joining us during the evening, your dinner time, I'm guessing, to take the time, 1.5 hours here to join us. Zain, maybe you can share the slides. Okay, yeah, thanks. So we'll just start, we'll be concentrating mainly on two sectors, mainly the tech sector. So that's like the usual, the Max 7. So we'll be concentrating on the Max 7 stocks, and as well as a bit on the banking sector and a bit of the new initiations that we have. But just to explain what this picture is, is generated using AI, right? That's the big talk of the town now. And, it's like the AI stocks or the tech stocks in general are having a bit on a roller coaster, right? It's up and down, but now we are climbing up, and we just want to see how far can we continue to climb, and if there and the reasons why we believe so, at least for each of the different sectors. So next slide. Yeah, this is just our usual disclaimer slide, just to let everyone know that all our information comes from public resources, and also to please approach your financial advisor before you make any financial decisions. Next slide. Yeah, so again, like this is the content and the flow for today. We'll be starting off firstly with third quarter performance review and what has been happening in the market, just a brief one, and then going through each of our sector teams. So we have like a EV, banks, and also other different sectors that each of the analysts in my team cover. And we'll be having we have two recent initiations as well, AppLovin as well as Oracle, and then we'll do the technical pause and the conclusion, and also to end it off with the Q&A. So do put your questions in the Q&A tab below, and we'll try to get through some of them, or if not all of them, and the most unvoted ones will be answered first. So now let's just start off with our first. Yeah, so just a quick review of the third quarter 2025 market performance. Yeah, the Max 7 has continued to recover very strongly in the third quarter. So we thought that first half, we saw a bit of a recovery, but it's really pretty flat. But look at the third quarter, it has outshone almost all the other sectors, right? Even gold, right? So gold was the second highest, coming in at 17%, but it's still having a pretty bumper year to date, 47%, up 47%. But Max 7, the Max 7's stocks are quite close behind. You can see, year to date is 18%, and third quarter is also 18%. So a lot of the recovery that we saw actually came from the third quarter. The first and second, or the first half, it was more of a recovery, trying to recover from, I guess, whatever Trump said, during the Liberation Day and with the tariffs and the trade war. So the third quarter is where we actually saw some growth, right? Yeah. So now moving on to the next slide. Just briefly touching on the USD, US dollar has recovered slightly, right? It was very sluggish in the first half and particularly in the second quarter of this year. By the third quarter, we saw, I guess, the volatility did ease down a bit. We saw some good growth numbers as well coming in from the US, and I guess that's what, sort of improved the investor confidence, and USD did recover slightly in the third quarter. Now moving on to the next slide. Yeah, so for the concentration of the Max 7, it has reached a new high. So, it did pull back slightly from the Liberation Day, but then it has continued to rise from there, and it actually reached a new high, which is what we are seeing now. It's above around 36% of the total S&P 500. So the Max 7 set of stocks are actually getting bigger, and also, they're getting stronger and making up more of the S&P 500. So we believe that they are gaining more importance. If not, they were already important to begin with, but now it's getting more and more important, and the concentration is actually getting higher. Moving on to the next slide. Yeah, and then a lot of worries, regarding the valuations, and if the tech stocks, and more particularly whether the Max 7 stocks are actually running out of steam and if they are overvalued. But if we pull it back, the 10-year average, it is still below that 10-year long-term average of 31 times, right? It's slightly below. It has climbed up definitely slightly in the past few quarters, but at around 30x, the PE is still below the long-term average of 31 times. So we believe that there's still some room for it to grow before being, I guess, in that overvalued kind of territory. Yeah, next slide. Yeah, so we'll just briefly look at this AI-related stock performance. AI is the big top of the town. It has continued to be in the headlines, right? It's not going anywhere. So you look at AI-related stocks. You have stocks like Palantir, which is AI, and defense as well. So that's like a double positive. So that's the strongest performing stock for the third quarter. But you look at Broadcom, Nvidia, AMD, they're all doing very well. Microsoft as well doing very well, but look at the laggards, at the bottom there, you see Apple, right? It's down 29% for the third quarter. And that's because if everything is related to AI now and Apple is really lagging behind in terms of the AI related performance, right? They have not come up with any new, they haven't come up with any new AI. Apple Intelligence is lagging behind, and they are also even using other providers like OpenAI or ChatGPT to service their AI requirements. So that's the main reason why we believe that they have sort of lagged behind. My colleague later, Helena, will go through in deeper detail, dive into Apple. So let's move on to the next slide. Yeah, in terms of performance for the Max 7, at least for the last quarter that we have seen, six out of 7 of them have outperformed. If you look at the results, against their guidance and against expectations, they have outperformed. They have also grown incredibly well. The only outlier here we see is Tesla, and the main reason for that is because of the poor deliveries and with whatever Elon Musk, which is their CEO, is doing, right, it does really affect the performance of the Tesla's results and whether or not people will buy their cars. I will go into more detail on Tesla later. Next slide, please. Yeah, so I'll just jump straight into the sector teams. We'll start off firstly with the US banks. Yeah, sorry, hopefully my volume is up. I think hopefully the participants can hear me properly. Yeah, anyway, so the US banks, the main thing that we're looking at is the rate cuts. Sorry, yeah, it's a bit soft. I'll speak a bit louder. Yeah, the rate cuts. So the rate cuts are actually quite welcomed for the US banks, and we'll go through the main reasons why we believe this is so. So just do a quick overview or review of the second quarter results. So that's the most recent results that they have. And the main highlight is that asset management fees for all three banks were very strong. And that's really coming from, a lot of the investors are putting their money into wealth management products. And also they are growing and they are being more aggressive in trying to gather AUM and to put that AUM into good use. Hence why we believe that their asset management has actually gone up and will continue to go up, especially now with rate cuts that have come in and more that we expect to come in the later part of the year. And the good news is also provisions here in the first bar here at the bottom. You can see that provisions haven't moved much, right? I guess gone are the days where we have seen a spike up in provisions, and also we have seen gone are the days where they are not doing any more write backs, because I guess they have finished doing whatever they could write back, right? So now it's pretty flat, and we also expect it to continue to be relatively stable moving forward. In terms of EPS, the outlier here will be JP Morgan, and that's because they had this huge Visa share increase in the second quarter of 2024, which is why it's sort of a negative year on year. But if you remove that, it's actually positive. Whereas the other banks are also seeing quite positive returns in terms of EPS on a year-on-year basis. Now, moving on to the next slide. Yeah, just the usual net interest margins and net interest income compared against the Fed fund rates in the red line here. So it's quite stable, right? Net interest margins have held up, and net interest income has actually grown slightly during the same period, mainly from loans growth. We believe that when rate cuts kick in, we could see margins actually improve slightly because of the cost of funds for the banks. And that will be in my next slide here. Yeah, so the bank's cost of funds, the green line is basically their asset repricing. So you look at asset yield, and the difference. And the second one, the red line here is the cost of funds repricing. So if you go back a bit and you look at the June 2022, so somewhere in the middle of the chart here, you can see that the asset repricing spiked up over the cost of funds repricing, and that's where we see this huge jump in the margins, right? And recently, what's happening is that if you look further, around June 2024, the cost of funds repricing was higher than the asset repricing, which is why we saw a decline in the net interest margins. What's positive is that they have stabilized it somewhat, where asset repricing and cost of funds repricing is relatively almost on par. But with rate cuts coming in, we expect that these will ease the funding costs for the banks and also improve the net interest margins for the banks. So actually, it's a bit of a positive for the banks. If rate cuts come in, then they can kind of cut down their deposit costs, and this will improve their margins. Next slide, please. Yeah. Like what I said earlier, loans growth was what was bumped up the net interest income because margins were stable, but you saw net interest income increase. It's really coming from this loans growth, and it has accelerated from the credit card, residential, as well as non-farm, non-residential CRE, but it's still below the pre-pandemic average, right? It has spiked up definitely, and we believe that this will continue to grow and will continue to accelerate, especially with rate cuts coming in and even more rate cuts, which are to be expected for the later part of the year, the end of the year, and also next year. There are more rate cuts coming in as well. So this will help to improve the loans growth and help to buffer that net interest income for the banks. Now moving on to the next slide. Another important, I guess, point that we look at for the banks would be their coverage ratios, whether or not it's stable, and it shows whether they are well provisioned, and it's actually quite stable. They have maintained it above the pre-pandemic levels, so that's quite safe, and I don't think it's going anywhere moving forward. Allowances have also, been pretty flat, and I don't think we will see a spike up. Next slide, please. Yeah, so we also believe that the rate cuts, like I said earlier, I've been mentioning a lot, is that it will help to improve the cost of funds and it will also help to improve ROE. So yes, it rose slightly in the last few quarters, but in the most recent quarter, it was actually flat, right? Because we saw that balancing out of asset repricing and cost of funds repricing. But if rate cuts come in, we believe that this will improve cost of funds and the banks can have a better ROE moving forward. Yeah, so I think that's all. Next slide. I think that's all for the banks. I'll now jump to the other sector, which I also cover, which is the EV sector, and I think more specifically Tesla. So the title is that there was some pickup before the end of the EV tax credit, and we have seen it in the deliveries numbers. Next. So more in third quarter, we saw this huge spike up, and these are Tesla delivery numbers. They just released it, I think, a few days ago. So we did see a record number of quarterly deliveries, right? They hit a new high of 497,000 in the third quarter, and it's the highest year-on-year growth of I think it's up 7% in 7 quarters. So in almost 2 years, this is the highest growth that we have seen. In fact, the last few quarters, what we have seen is not even any growth, right? It's really a decline in deliveries. So this is finally some good news for Tesla. But like I said earlier, right, it might be a rush for customers to buy their EVs, right, before the $7,500 EV tax credit disappears. So it has already been removed as of the end of September, right? So only in the fourth quarter, if the numbers still remain strong, then that's a good indication that Tesla has sort of helped to turn the tide around and to convince customers to buy their cars instead of jumping ship to their competitors in the US, like Ford, GM, and even Hyundai. Now moving on to the next slide. But in China, it's a different story altogether. They don't have this, I guess, sudden removal of the tax credit for EV cars. So it has slowed for Tesla, continuing to see this decline in sales. August was yet another decline, -4% year-on-year. And the interesting thing is that BYD's growth has also slowed, but they still remain positive, right? The market is still growing in China, and BYD is still continuing to gain a bit of market share there. But Tesla is not just seeing a decline in sales, but they're also seeing a decline in market share in China. So that is their second largest market, and it's quite important. And yeah, so the next slide will show. Yeah, sorry, Nick. Yeah. So, the China market share has been on a downward spiral. We are seeing it increasingly decline, right? It's from 6.7%, now they're having only 5.1%. So that's very disappointing figures. But for US, right, it has increased slightly because of this end of the US the EV tax credit. So we did see it pick up slightly, but we will only be able to see if this is a continuous trend and if this can be held up in the next quarter. If this declines again, then you know that it's really just a one-off because of this removal of the tax credit and customers rushing to buy a EV car before they lose out on this $7,500. Yeah, the next slide we'll see the outlook, I guess, for the rest of the year. So the CEO, Elon Musk, he did buy back like $1 billion worth of Tesla shares, and that's what helped to support the share price. I guess he realized that he saw the share price declining and said, okay, it's quite worrying. I can't increase my delivery numbers, but at least I can buy back shares, right? And I mean, he is the richest man on earth, so I guess he still has enough. He has 1 billion, it wouldn't be like a bit of spare change for him. So it did boost the investor confidence, and Tesla share price did run up, right? And like I said, also, the end of the tax credit will be a long-term negative, but it did provide a windfall for them in the third quarter deliveries. We do expect it to fall off in the fourth quarter and especially next year. But if it does manage to sustain growth, right, any kind of growth, then that will be a positive for Tesla. What they've done recently is that they have introduced, or at least announced, this cheaper, or some people are calling it the budget Model Y. It's only around 10% cheaper, and this is to combat, firstly, the EV tax credit removal, and also to combat against a lot of their Chinese competitors, and not just Chinese competitors, but a lot of their local, the US competitors as well, because they are competing now on the price, right? So they have to continue to fight on the cost front. Consumers are shifting away, from buying, like being brand conscious, but now they're being more price sensitive, as well as looking at the features of the car. So that's what Tesla has to do to continue fighting. And I guess we'll only be able to tell if this is effective when the car is rolled out, and whether or not delivery numbers have increased. But we do still have a sell call on Tesla and a target price of $220. I guess that's all for me. I'll now hand it over to my colleague Iqban for the semicons. Thanks.
Thanks, Glenn. I'll be covering semicon for this portion. The title is Still Room for Growth. I will explain more later. Next slide, please. Yeah, so talking about equipment, so basically ASL, Applied Material, as well as so they are trading 12 months revenue growth. Revenue rate of change is being reflected by the red color line over here, and the blue color line reflects TSMC's capex numbers. So as you can see, TSMC capex is very closely correlated to the equipment makers' revenue. This is because TSMC is one of their largest customer now, with regards to high-end equipment. And for the most recent quarter itself, second quarter, equipment makers' revenue increased by 18% year on year. So there is an acceleration compared to the previous quarters. It is the highest since second quarter 2023. However, for the next two quarters itself, they did guide a slight slowdown in terms of revenue growth. This is because for TSMC, they maintain their capex guidance. They did not increase it. So a lot of analysts are expecting that for the next two quarters, there will be a slowdown in terms of TSMC's capex growth. And this will definitely impact equipment makers' revenue for the next two quarters, because there will be a slight slowdown in terms of orders for their equipment itself. However, even with the slowdown itself, we are still seeing 14% year-on-year growth for the next two quarters. So we are still continuing to be positive on the equipment makers. Yeah, next slide, please. Yeah, so talking about NVIDIA and AMD. So so these two lines reflects the data center segment revenue for both NVIDIA and AMD itself. For the left side, the axis represents NVIDIA, and for the right side, the axis represents AMD's data center revenue. And for NVIDIA, represented by the red color line itself, we have seen a huge ramp in data center revenue starting from first quarter 2023. And we can see that they have been keeping, they are having a very tight kind of race to gain market share in terms of, for example, when NVIDIA released the Hopper GPU itself in third quarter 2023, AMD caught up by releasing the MI300 GPU chip 2 quarters later. And then also for the most recent first quarter 2025, NVIDIA released their Blackwell chip. Sorry, that one refers to Blackwell chip. And AMD also released their MI355 chip in June itself. So for the next quarter, we do expect a ramp in the second half second half of this year itself. And we do expect this kind of ramp because AMD's hardware is comparable in terms of inference performance compared to NVIDIA's GPU racks. And it also outperforms NVIDIA's memory performance in terms of in the form of about 1.6 times. So we are positive to see this kind of ramp in the next 2 quarters. For the latest second quarter results itself, we do see a slight kind of dip. This is because their data center segment is being impacted by China sales because the US government has put in some restrictions to ban chips to China. But however, we even with this sort of impact from China, they are still able to ramp their data center revenue growth. For AMD, it increased by 14% year on year. For NVIDIA, it increased by 54% year on year. Yeah. Next slide. Yeah, so talking about AMD, this is the snapshot of the recent developments. I'm sure many of you will have questions about OpenAI's deals with AMD, NVIDIA, as well as Oracle. Yeah, so I think generally, if we look in terms of the red color words, so that is the GW stands for gigawatt of data center deployment. So OpenAI has made deals with Oracle, NVIDIA, as well as AMD to put in some investments with them, and then they will help OpenAI to build up the data center AI infrastructure. So to put into perspective, 1 gigawatt of data center power workload can power about 1 million homes simultaneously. So if you think about it, that's about the size of Singapore already. Yeah, so that puts into perspective the kind of scale that OpenAI has with these companies. So firstly, for the Stargate project, OpenAI has made a deal to put in $300 billion with Oracle, and Oracle will help OpenAI to develop 4.5 gigawatt of data center. Similarly, for NVIDIA, NVIDIA has made a deal with OpenAI to pump in $100 billion worth of investments over 4 to 5 years, and in turn, OpenAI will buy NVIDIA's chips to develop the data center workloads. So that will bring in about $350 billion in sales to NVIDIA. And then for AMD wise, AMD has made an agreement with OpenAI to build about 6 gigawatt of data center, and in turn, OpenAI will spend about $130 billion worth of money on AMD. So this is the overall development. We do think that this development is very positive for AMD itself because AMD currently only has a 10% market share in terms of GPU. However, as you can see from the size of the deals itself, OpenAI has an agreement with NVIDIA to build 10 gigawatt of data center. OpenAI has 6 gigawatts of agreement with AMD. So it's almost similar in terms of the size of the scale. And for next year, second half of next year itself, OpenAI will deploy 1 gigawatt of GPU racks each from NVIDIA as well as from AMD itself. This shows sort of a stamp of approval as well as an endorsement from OpenAI for AMD's chips itself, because OpenAI sees AMD's chips to be competitive to NVIDIA before they are willing to put in such a large size. an increase of about 70%. For AMD wise, we just released a report, so our call for AMD is still testing. Hello, sorry. Testing, can you hear me? Hello, testing.
Yes, we can hear you now.
Oh, okay, sorry. Yeah, next slide, please. Yeah, sorry about that. Yeah, so talking about NVIDIA next. Yeah, sorry about that. Yeah, so just now, I think there will be some questions about whether these OpenAI deals will form a bubble or whether it is sort of an artificial demand. From my view, I do think this OpenAI deals is a bit artificial because NVIDIA will pump in $100 billion worth of investments to OpenAI, and then in turn, OpenAI will buy back their chips. So it's a bit artificial. But I do feel that the organic demand for AI GPU chips will come mainly from hyperscalers, and in this aspect, it is still positive. So, for example, Google and Meta, they recently increased their full year 2025 capex guidance by 13% and 10% respectively. And also Amazon and as well as Microsoft, they are more aggressive in their tone to increase their spending in terms of capex. And we do estimate that about 50 to 60% of the capex will go towards AI GPU chips. So 90% will go towards NVIDIA, 10% will go towards AMD. That's our estimates. And I think for the next 2 years, this is still expected to grow. The capex is still expected to grow, even though there may be a slight slowdown in terms of capex growth, represented by the red color line. But however, we do think that 2026 there will still be about a 14% increase in capex. Yeah, so that in that aspect, we are still positive on NVIDIA. We do think that there is strong organic demand, and we do think that there's also demand coming from sovereign countries. For example, I think there's a new news from UAE spending money, investments in NVIDIA's chips. And the European Union and European Commission has also increased their budget on building up AI data centers in Europe itself. Yeah, so from sovereign nations, we are also seeing strong demand for high-end GPU chips. Yeah, so I think that's all from my end. I'll hand over the time to Fahmi. Thanks.
Test. All right, hi. Good evening, everyone. So I'm presenting on the software and the cloud industry, which we think that the cloud demand outpaces infrastructure capacity. Next slide, please. For the sector summary, so first we're going to start with the sector summary. So for the software summary, a common theme that we are seeing on the software industry is that people are talking about the cloud computing and the AI space. So most companies are dealing with the limited capacity. Demand for the AI services, whether for consumers or business, keep growing faster than the infrastructure can support. So that's led to some unexpected partnership and deals for the computing power and hardware that you guys read on the news. So what's been most surprising is how strong and steady the demand remains even for this quarter. We have two key observations. First is that the demand for AI services across both consumers and enterprises remains strong, and meeting that demand continues to be a challenge. And second, several companies also report that their internal use of AI is already driving meaningful productivity gains. So for the recent quarter, the second quarter, software sector revenue growth accelerated to 16% year over year, which was up from 13% a year ago. If you look at the table, the gains were led by Microsoft at 18% year-over-year revenue growth, which contributed to 11 percentage points to the sector's overall performance. So this is also helping to offset slower growth in the customer relationship management. We split the SaaS companies into three categories. We got productivity, CRM, and ERP. So let's take a look at some of the companies that is under our coverages. For productivity, we have Microsoft, which are the companies that offer software to, Microsoft growth makes about 70% of the software sector growth. And it's safe to say that performance of the software industry is very dependent on Microsoft. So Microsoft reported 18% year-over-year revenue growth and led its cloud services business Azure that accelerated year-over-year, surpassing prior guidance. The growth was driven by the increasing need of the renting of supercomputer offerings through Microsoft Cloud Services business Azure. Next, we got CRM. For the CRM refers to the companies that offer software to manage a company's interaction with the customer and the sales. We think that they are laggard in the industry. Salesforce revenue grew only about 10% year-over-year, which is below the productivity and the ERP segment. Operating margins for the Salesforce expanded for the 10th straight quarter. For the next quarter, Salesforce project total revenue growth of 8%. For next one, we have ERP. ERP segment companies that provide systems that manage and integrate core business process like finance and HR all together into one module data. So Oracle posted revenue about 12% year-over-year. Oracle's biggest winner is its cloud infrastructure segment, which delivered the strongest growth in the recent quarters, rising about 55% year-over-year, and even higher than a year ago, which was 45%. So this was fueled by the increasing demand for renting computer power and storage services. So yeah, for the outlook, the company expects the remaining performance obligations to exceed 500 million in the coming months and expect its cloud infrastructure revenue to grow by 69% year-over-year. Next slide, please. Thank you. Now we talk about Microsoft, which is part of the software industry. Our title is Azure Outgrowing Legacy Business Lines. You look at the chart that we could see that the cloud services business, which is the intelligent cloud, which is colored in the orange, has grown steadily, increasing its share compared to the other segment. It was 29% of total revenue back then in 2018, but now it is 38% in 2025. The pattern is more and more consumer and enterprises shifting their usage to the cloud-based product and services. The reason behind this shift is because its cloud services business Azure, which continued to accelerate. In the recent quarter, Azure revenue grew about 39% year-over-year, well above the company's 34% of guidance. There's also the Azure AI, artificial intelligence, continue to contribute to the business. For the outlook, Microsoft keep emphasizing that continued strong momentum to address a significant contracted backlog of 368 billion, primarily driven by cloud and AI demand. The company is ramping up its capex for the year, but at a more ponderate pace than last year. So an observation for Microsoft is that we think customers continue to adopt Copilot at a faster rate than any other new Microsoft suite. What interests me is that the fact that we have all large companies that the pattern is that upscale their purchase for Microsoft AI, which is Copilot, after they buy in a small amount first. We saw companies buying, you read in the news that companies buying small amount of seat of Copilot first, then they return to buy more seats. For example, banking like Barclays, for example, rolled out Microsoft 365 Copilot to 100,000 employees globally, following a successful initial deployment of 15,000. And then you get UBS is expanding its own deployment to all of its employees after initially rolling out about 55,000 of them. So looking at this pattern, there's still room for growth for Microsoft because these companies might come back and buy more Copilot seats for more employees. AI is becoming more and more important to even not to one specific industry, but to many industries. There's very lot of variety of useful way to use AI, and Microsoft is the leader in providing these AI services. We maintain a cumulative recommendation at $550. Microsoft continue to expect higher earnings for Azure despite facing supply constraint. However, we see upside potential given the backlog of $368 billion, which is 1.3 times of its financial 25 revenue. That is all from me. We'll pass over to the next presenter. Thank you.
Thank you, Farmi. I'll continue on e-commerce. I think for all the past speakers, we received comment that the audio is too soft. So apologies for that. I'll try my best to speak up a little bit. So for e-commerce, our theme is it's still the calm before the storm. Next slide, please. So first, let's take a look at how the US consumers are spending right now. So this chart tracks Still stuff. Okay, sorry, I'll try to speak up. So this chart, it tracks the year-on-year growth in US retail sales since 2020. So you can see the sharp pandemic spike in 2021, where stimulus and lockdown demand drove a boom, followed by a pretty long, steady slowdown. And since early 2023, growth has been pretty flat at about 2 to 3%, barely keeping up with inflation. So that kind of means that in real terms, people aren't really spending more, they're just paying more for the same goods. So what's really behind this softness? First, higher borrowing costs because credit card rates remain nearly 20%. So that's limiting spending. And second, because saving buffers have dried up, especially among the lower income household. And finally, student loan repayments resume. So that's taking another bite out of the disposable income. So even though job data looks pretty healthy, the sentiment is pretty weak. So consumers are now more cautious, and that restraint is now showing up clearly in the retail sales number. So for e-commerce, it matters a lot because e-commerce during the pandemic period, they have years of double-digit growth, and now the sector has normalized. Sales are stable, it's not really accelerating anymore. So now it's really feeling the calm on the surface, and the calm may not last long because with the tariff kicking in, we've actually expected impact since the last quarter, but somehow it hasn't really showed up yet because many of the firms, they're still running on pre-tariff inventories or they're trying to absorb the cost. And most of the e-commerce players are claiming that up to now, they have not yet seen a clear trend of spending demand decreasing. So we're continuing keeping a close watch on the numbers, but likely we'll foresee margin pressure, price hikes, and softer demand in the future. Next slide, please. Now turning to Amazon. So we're seeing a pretty interesting divergence between its retail and AWS businesses. So if you look at this chart, which is a chart of the operating margin for both retail and AWS, so we take a look at the retail operating margin, which is in dark blue. It has recovered sharply from negative territory in 2022 to now around 4 to 5% today. So this improvement has been driven by their consistent efficiency gains, particularly in logistics and cost discipline, as they try to optimize its regional fulfillment network. What's notable is that this margin expansion comes even as consumer spending remains soft and the whole tariff scene weighing in. We do expect some normalization later this year, but even with that, Amazon, we still think will remain a relative outperformer versus other e-commerce peers, thanks to its scale, logistic integration, and its prime ecosystem. On the other hand, its AWS margin, which is shown in orange, have contracted for the first time this quarter. So that's primarily due to heavy capex investment in cloud infrastructure and AI capabilities. We don't see this as a red flag. It's actually a healthy sign of continual reinvestment to capture long-term demand. So their investment growth rate, it decreased, but it's still growing and from a already very big base number. So that's very healthy investment. It's a strong sign that Amazon is still seeing loads of future demand coming in, like Iban just mentioned earlier. So AWS continued to grow at double-digit rates and its backlog expanding solidly as well, above 20% year on year. So overall, we think Amazon is transiting into a more efficient and future-ready platform. We remain optimistic on both segments. They're going to be resilient in retail, even with the tariff shocks, and they're going to have a long-term structural growth in AWS. So overall, we have a buy rating for Amazon with a target price of $260. Let's move on to hardware, specifically smartphones. So what we're seeing here, next slide please, is that the global smartphone market has entered a slower growth phase. So after a strong rebound in 2023, shipments have started to flatten through 2024 and into the mid-2025. So you can see from the chart here that year-on-year shipment growth shown by the orange line have moderated to around low single digit. So this slowdown isn't necessarily a bad sign. It kind of reflects a more mature market rather than a collapsing one. So most consumers now, they're holding onto their devices longer. The replacement cycle have stretched to around 3 to 3.5 years globally. And at the same time, their average selling price is still rising, which means brands are relying more on premiumization and feature innovation, which so the next big differentiator now is really the AI integration. So the smartphone makers, they're really increasingly pitching AI as the reason to upgrade. So whether it's on-device generative AI, personal assistant like Samsung's Galaxy AI, or Huawei's image editing, or Apple's Apple Intelligence suits that's slowly coming in. The message is the same. AI will really redefine what a smartphone can do. We're seeing a clear shift now from hardware-driven upgrades to experience-driven upgrades powered by the AI. Moving on to the next slide, which shows global smartphone market share. So there are some quarterly fluctuations, but generally Samsung and Apple, they continue to dominate, each holding around 20% and 14% of global market respectively. Meanwhile, China players like Xiaomi and Oppo, they're holding shares, but they're focusing more on affordability and integrating AI through localized ecosystems. Moving on to the next slide, now we're going to zoom in more on Apple. So Apple today is actually exactly 1 month since their rollout of iPhone 17. So we would just like to give you guys a breakdown of the rollout. So first we take a look at the price points for the iPhone 17 launches. So the iPhone 17 entry price, which is the lowest cost for the entire line, remains at $799. So this is consistent with the prior generation, but the key shift is that the base iPhone 17 now starts at 256 GB instead of 128 GB. So that effectively raising the storage value at the entry point. And also notably, Apple, they have completely eliminated the 128 GB option across the lineup. So that kind of makes the iPhone 17 Pro appears more expensive, even though its entry price of $999 remain unchanged if you compare it with 16 Pro with the same storage. So this is why sometimes you see headline people saying that iPhone 17 is more expensive than 16. That is because the 17 Pro entry price increased a little bit, but that's not really comparing apple to apple. So it's not a fair comparison. And on the top end, Apple has extended the premium tier with iPhone 17 Pro Max. It's now offering 2 TB, setting at a new all-time high as the most expensive iPhone. And meanwhile, they've also introduced iPhone 17 Air, which slotted above the standard iPhone 17 because it's priced more on the premium side. This is kind of overlapping with the Pro territory. So it's been exactly 1 month since their rollout. They've reportedly exceeding the internal projection of early sales. We don't have the specific numbers, but Apple, they have been asking some of their suppliers to increase production of the base iPhone 17 by around 30 to 40% in order to meet up with the pent-up demand. So I think the reason behind it is they do seem to have some good features upgrade, and it's better value now because they have a bigger storage in the base model. Because they have kept the price the same, so it's like people will think like, of course, I'm gonna pay the same price. I've got more features. But among the new models, the iPhone Air seems to be lagging behind because we think it has lower specs. It has single lens camera. It has a smaller battery, making it less appealing, especially when Apple tried to price it as a premium model. And also because Air hasn't really launched in key markets like China, so the evaluation is not very complete. Next slide, please. I think we continue to see very limited evidence of a strong upgrade cycle. They do have some good features, but notably they still lag their peers in terms of AI, especially when their Siri AI update is delayed until 2026. And also we think the price for the iPhone 17 lineup remains unchanged compared to the 16, which is a good thing, but it kind of also implies that Apple, they're really absorbing the tariff-related pressures and the higher production costs that came with it. So this will likely weigh further on their margins, which is why overall we still maintain a pretty cautious outlook. So overall, we have a reduced rating with a target price of $200. So that's all from me. Now I'll pass my time to my colleague.
Hi, thanks, Helena. Good evening, everyone. I'll be presenting the digital advertising segment in which I title AI spend meets monetization power. So after spending billions of dollars on AI development, moving forward, we will be closely follow whether the digital ad company are able to monetize it through the product offering. So before we actually dive into the company specific, we actually see the current industry landscape remain positive. So we see the comment from global marketing agency. They says that the global advertising spending growth is expecting to moderate in 2025 because of economic uncertainty, but the growth rate remain quite resilient with the global ad sales anticipated to grow more than 6% in 2026. This is driven by the major events returns such as FIFA World Cup and also US midterm election, and also strong ad spending on digital advertising. So the slides right now, you can see one of the key metrics that we focus on will be on the average revenue per user, because it directly measures how effectively the platform actually monetizes the user base. If you look at the chart, Meta actually consistently have the highest ARPU. This is rising around $6.5 in 2018 to $14 in 2025, showing a quite strong monetization per user, because with a platform like Facebook and Instagram, user actually spends a lot of time engaging with a very diverse content. It helps with generating very rich behavioral data, so the advertiser can actually use it to target very specifically, especially now Meta will continue to improve their AI recommendation model, so it will drive the willingness of how much the advertiser is willing to pay. And the next one is Reddit. The starting ARPU actually reported around like $1.4. It has been growing quite rapidly to $4.5 in 2025. This is a three-floor increase in under 5 years. We believe that the increase is due to an improvement with the native ads and also the premium features. So the unique community targeting actually allows the rapid ARPU growth, even though the overall user base is much smaller than Meta. And also Snapchat ARPU actually fluctuate between $1.6 to $3.5. This is actually is a moderate growth over time. And in terms of Pinterest is actually lag with the lowest ARPU. It's ranging around $0.7 to $2. This is actually showing a slow but okay growth. So overall, we actually see Meta actually leads in monetization power, and Reddit actually shows the fast improvement, while Snapchat and Pinterest actually grow more slowly. Next slide, please. Thank you. So for Meta, as for the same quarter this year, the company still report a very strong revenue at 22% year-on-year. This is due to a very strong demand in online e-commerce vertical, and also, like I said, the continued improvement in ad performance and also user engagement. So Facebook and Instagram user actually spending more time using the app, which actually directly contribute to the 11% year-on-year growth in terms of ad impression. We also think that Meta's strategy to actually optimize the ad volume, which is the ad inventory, particularly across Facebook feeds and also video surface, actually helps to boost the impression goal. It gives more leverage for Meta to actually increase the per user monetization. In addition, we think that the AI-powered recommendation model actually drives the ad conversion rate on Facebook and Instagram by using a more user behavior signal and also longer historical context. So the average price per ad actually grew 9% year-on-year in the second quarter because of the strong advertiser demand and the better ad performance. The company also mentioned that currently nearly 2 million advertisers, which is around 20% of Meta advertisers globally, are actually now adopting Gen AI power video generation tools, which actually we believe that could encourage more ad spending from small to medium sized advertisers with limited resources. At the same time, Meta also started to roll out ads in Threads feeds, which the company mentioned that they will be focusing on scaling right now instead of monetization. So we estimate a revenue growth of 26% in the next quarter because of more pipeline to boost the ad business, including WhatsApp, while we also do expect an operating margin expanded to 55% because of improved Gen AI capabilities to boost the user engagement and also ad efficiency. So for Meta, we actually have an accumulate rating with a target price of $830. Next slide, please. Thank you. Next, for Alphabet, digital advertising business continue to be the core business for the company, but we actually started to see more revenue contribution from Google Cloud business, which is around like 14% right now. Google Cloud business is currently growing around 32% year-on-year, and it actually remains Google fastest growing segment. So you can see from the news that the most recent high-profile deals actually include $10 billion contract with Meta and also OpenAI. Moving forward, we actually remain positive with Google Cloud business because the company actually mentions that there is $106 billion backlog and also a very high demand for enterprises. We think that it will actually push forward the expansion of CGP client base, which is growing around 28% quarter-on-quarter basis. But at the same time, we will also be focusing on the capacity timeline, because as first, Alphabet actually mentions that they expect to see the improvement by end of the year, but during the last earnings call, they say that it's now being pushed back to 2026 to see the improvement. But regardless, we believe that the revenue growth will continue to show it once more capacity became online. So for financial year 2025, we actually expect a cloud revenue growth of 35% year-on-year. Next slide, please. Yeah, thanks. As for Alphabet's search business, we actually continue to see Google's dominance in traditional search, which is around 90% of the market share. Based on the recent court ruling from the US judge, we actually agrees that the competition now actually lies on the Gen AI search landscape, in which OpenAI's ChatGPT actually leading the market share around 60%. Compared to Gemini's 13.5%. So next slide, please. So based on the recent disclosure by OpenAI on Monday, during the OpenAI Dev Day, they are actually currently around 800 million active user. They're using ChatGPT, which is double since February, but we remain positive about Alphabet ad business because we believe that Alphabet's Gen AI chatbot, which is Gemini, and also traditional search engine actually are showing resilience despite the intense competition from ChatGPT. So Gemini was actually launched in March 2023, and it now actually has 450 million monthly active user. And then Alphabet also sees the daily requests actually grow 50% from the first quarter. This can suggest a surge in the user engagement. And Gemini also currently has doubled the process token since May, which indicates that they will be able to handle a more complex query, but at the same time, users are asking more complex queries to their AI chatbot as well. So and then AI overview in search now has actually more than 2 billion monthly user, but even though with such a skill, it's still driving a 10% more queries globally. We think that it actually reflects a very strong user interest in AI enhanced search experience. So overall, we actually believe the Google advertising business will continue to be strong because the first one is because we do see a stickiness in user behavior, and the second one is we think that there will continue to be a higher engagement with a better quality data, so that Alphabet can actually use it to enhance the ad targeting capabilities. Over the long-term basis, we actually do believe both services could be integrated for more efficient ecosystem. So this is why for Alphabet, we actually have an accumulate rating with a target price of $265. Next slide, please. So recently, we actually initiate a new coverage for AppLovin. Next slide, please. Thanks. So a little bit of introduction for those who are not familiar with the company. It is actually an advertising technology company which IPO on April 2021. So compared to Meta and Google, which focus on more on a broad-based social media ad and search ad, AppLovin actually specialize in mobile advertising, particularly within the gaming sector. This month, the company also started to expand to e-commerce vertical. And in September, AppLovin actually was added to S&P 500 as well. So there are actually four main products that provided by AppLovin. The first one is actually called App Discovery. It's actually a user acquisition and marketing platform for advertisers. This is the primary source of AppLovin advertising revenue. So how does it work is that under the App Discovery, the advertiser actually allowed to set a return goal, such as like installation, etc. And also target preference, such as location, and also category for their marketing campaign. So Axon, and then after that, Axon, which is the AppLovin AI power recommendation engine, will actually perform the algorithm to match with users which are likely to react to the ads. And then the second product is called Max, which is a mediation and also an ad monetization platform. The main user are actually mostly mobile app developer. They are also be called as publisher. They are the one that with the available advertising slot on their app. So how does it work is that the interesting thing about Max is that it's running on the real-time auction basis rather than a traditional waterfall process in which every network actually is checked sequentially based on the priority, so that when there is a multiple bidding for an ad slot from a different network, Max actually will be able to select the highest bidder to win the ad space so that they can maximize the value of the ad slot. And then the third one is called Adjust, which is a mobile measurement and also analytical platform. So advertiser can actually choose to pay a subscription fee, and AppLovin will actually provide attribution data and also in-depth reports so that advertiser can have more insights about their marketing campaign. And lastly, we have AppLovin CTV business is called World. It's currently distribute streaming videos from contents company, also provide advertising solution to maximize ad revenue and so grow CTV viewership, but CTV is currently not AppLovin business priority. So just a quick explanation about how do they generate revenue through this offering. So there are three components. The first one is Max, which focusing on ad monetization. Let's say that if there is an ad slot successfully being sold to via Max, AppLovin will actually take a cut as a mediator and pay publisher the rest. And also there are also some other ad tech company that which focus on the demand side platform. They will use Max to bid for the ad slot. So if it's successfully they got the slot, and AppLovin will actually charge a 5% tax for any impression bought via the platform. And AppLovin also generate revenue through app discovery. And since AppLovin actually focus on performance-based marketing, advertiser only have to pay for measurable outcome, such as in-store purchases and also engagement. And lastly, AppLovin also earn a very small portion of revenue from Adjust software as a service subscription. So our investment thesis is we think that AppLovin hold a very strong position in performance-based, performance-driven mobile game advertising, focusing on very measurable outcomes such as in-store, in-app purchase and subscription rather than brand awareness, which is what Meta do it very broad-based. And then we think that the end-to-end marketing tools actually support both advertiser and also publisher, while running the ad exchange actually be able to capture the value from developer and also the competitors. So with the control over monetization, also distribution pipeline, and also rapid growth from the Max mediation platform, AppLovin actually will be able to continue to scale the ad supply and revenue. So in October, AppLovin actually started to launch the self-serve ad platform. Their second quarter revenue actually up 77% year on year. And with the global expansion and also generative AI integration, and actually expected to further enhance the accessibility and also targeting. So we project a revenue growth of 55% for financial year 2025. And then the second investment thesis is we think that it has a niche and also growing market opportunity. So AppLovin is very well positioned to capture a significant upside from the mobile app advertising market, including gaming as well as the emerging channel like e-commerce and also CTV. So the growth framework is now being applied to the e-commerce vertical because it's expanded to a total addressable markets. So during the e-commerce pilot, the initiative actually reached a 1 billion gross advertiser spend run rate by December 2024. And this is only with around 600 advertisers. So the in-app advertising market also projected to grow around 8%, compounding annual growth rate between 2025 to 2013, reaching around $580 billion. This is provide a growing pool of ad inventory and also user engagement that a company can monetize through the AI power platform. Next slide, please. Thanks. So like I say, in the second quarter, AppLovin actually delivered a very robust financial performance with the revenue growth 77% year on year. This is driven by the core gaming business. And the company adjusted EBITDA actually nearly doubled to $1.1 million because of the substantial operating leverage and also efficient scaling. In which they achieved 81% adjusted EBITDA margin. So moving forward, the company actually guided a revenue of 1.32 billion to 1.34 billion, with a target adjusted EBITDA margin of 81% as well. So this is why for AppLovin, we actually have an accumulate rating with a target price of $725. That's all from me. I think I'll pass the time back to Fahmi for Oracle. Thanks very much.
Hey, thanks, Rina. So hi everyone again. So we are initiating Oracle guide coverage on Oracle starting today. So for Oracle, as everyone aware, is a very well-known company these days, reported in the news. So it was established in 1977 and majority owned by the founder. The main business is that they offer cloud, database, and infrastructure services. But they also present in the 51 regions. But the focus for Oracle is the cloud infrastructure business, which is the fastest growing segment. But first, looking at the revenue breakdown, Oracle have 4 divisions. They have clouds, they sell software, they sell hardware and services. So they sell software native product for enterprises and hardware and services to supplement these cloud and software products. But the software license and hardware services revenue recently declined slightly year-over-year due to Oracle less emphasis on the less strategic hardware business. But the cloud business has been growing at teens digit, and in particular, its Oracle Cloud Infrastructure grew at above 55% annually. So Oracle has always been known for its software services ERP, with its NetSuite, Oracle Fusion Services. But with the recent announcements of its cloud infrastructure services significant growth coming up, business is doing well. The game has now changed for the companies. Now, I would say, like, instead of focusing, is a company-focused software, now it's more like cloud computing software. They are also regarded as a 4th hyperscaler these days. So what's interesting about Oracle is the company, infrastructure as a service, is a cloud service that provides virtualized computing resources like servers, storage, and network over the internet. So why we like Oracle is that they are very niche cloud infrastructure provider. So compared to the other hyperscalers, their products, which is OCI, is gaining traction with a flexible usage-based model and very diverse deployments compared to the other hyperscaler. And what's more special is that this OCI is very tailored for regulated industry. It offers strong compliance and data residency controls, including sovereign regions, where nowadays, I think even this year, when you want to do cloud computing, in many regions, there's very high regulated that hyperscalers need to comply. But Oracle managed to do this. So this is another strength for Oracle. They also partner with the major hyperscalers such as Azure, AWS, and Google Cloud. So this enables Oracles to embed their hardware and database directly into their data centers, and furthermore, helped Oracle in their bottleneck supply capacity. So this has drove their OCI revenue 55% year-over-year revenue growth, with a consumption of over 50% year-over-year. And even when we look at the industry of the IaaS as a whole, the global market grew about 22% to 171 billion in 2024, driven by the rising demand for AI infrastructure and accelerated cloud migration. As more and more people are using AI nowadays, the importance of hyperscalers is getting more importance. Second reason of why we like Oracle is because it's end-to-end database and GPU infrastructure provider. So Oracle have everything. They have database, they have infrastructure, and they also provide services. They also are in partnership with the other AI providers. So this enables them for tight integration of AI into enterprise workflow by running models close to the data, which is database itself. So they partner with NVIDIA and AMD to provide power AI training, and they also provide AI inference, which is a very huge market potential for them. They also partner with the other multiple LLM, meeting rising demand for cloud infrastructure. They also are the key player in the Stargate project, which is 500 billion project with OpenAI. Oracle would provide and build more AI data center capacity through long-term contracts. So this would position them for the next few years, strong recurring revenue and growth when they lease these data centers to the users. And the third why we like Oracle is because their huge RPO backlog. Recently, with the recent quarter, their RPO increased to 365% year over year, and it's reaching 555 billion, and that is 7.9 times of its last year revenue. So we think that if they could quicken the conversion of this RPO to the revenue, they would could accelerate the revenue and the profits. So as demand is currently exceeding the supply, Oracle can accelerate profit by scaling capacity and converting backlog and leveraging multi-cloud partnership. Next slide, please. Next is that OCI demand fuels growth amid limited supply. This is the OCI product, which is part of the Oracle Cloud Infrastructure. You could see that the it's growing well, 55% recently in the recent quarter. And yeah, so it's based on the reason that I mentioned earlier that this, because of this, OCI supports regulated industry and sovereign clouds needs is better than the other hyperscalers. So it's like the strength and niche advantage for Oracles. They also partnership with the other hyperscalers. You don't see other hyperscalers partner with the others, but you could see the Oracles partner with these companies. That's another added advantage for Oracles. So we initiate coverage with $350 target price, at implying PE of 80 based on the 5 years DCF models. This factoring the high capex that we would see for the next first 2 years, and also considering the Oracle's long-term guidance where they provided revenue for the next 5 years. So this PE, while this PE is above the hyperscaler average of 41, we think that it is very well supported by strong ROE of 85%, which is also above the hyperscaler average of 44%. Growth prospect for Oracle is stemming from expanding cloud infrastructure, a robust long-term contraction pipeline, and rising RPO. We see significant opportunities in cloud and AI, recurring revenue, and strategic positioning in regulated industry. Oracle's elevated valuation is supported by 455 billion RPO backlog, and with management guiding for possible further RPO growth this year. I think that's all for me for Oracle. Pass it to the next presenter.
Thanks, Fabi. Good evening, everyone. I'll go through the technical outlook. So first one, I'll talk about the outlook for the NASDAQ. So this is the chart, the weekly chart for the NASDAQ composite. So we titled it, it's currently trending higher towards the main uptrend channel resistance. So in the chart, the overall trend that we're seeing is that it continues to trade within this main uptrend channel highlighted in blue. And then in the shorter term time frame, price is currently trending within this ascending broadening wedge over here, which essentially price started to trade within that since July this year. So in the third quarter, there was a very strong recovery. The good thing was that price continued to hold support above the previous all-time high around 20,000 and just continue to trend steadily higher. If you pull out the moving averages, we do see that on the weekly, the price has also maintained at least above the 10 period moving average on the weekly. So that's still a very steady and strong uptrend that we are currently seeing for the NASDAQ. So in the fourth quarter, we do think that for the NASDAQ could continue to hit higher to try to retest this main uptrend channel resistance area over here, together with the resistance for this ascending broadening wedge. So that could bring us to a target of about 23,500 to about 24,500. So if we look at the midpoint target of about 24,000, and then as of yesterday night's last close around 23,000, that could be about a 4% continued upside from the current price levels into the fourth quarter. Okay, next up, I'll talk about the outlook for the S&P. So for S&P, we are similarly positive on it. If you look at in terms of the price action, in the third quarter, it was also very steady. Price remained holding support above the previous 6,100 all-time highs. And just essentially since May this year, price has just been steadily trending higher in this uptrend channel over here. So currently it's about 6,153 as of yesterday's night's close. And we see the price actually trending higher towards this retest of this main trendline resistance highlighted in blue in the chart over here. So this main trendline resistance has been acting as quite a bit of a significant resistance, I would say, since March of last year, where few retests of these levels have frequently led to some notable pullbacks along the way. So we think that price will actually do a retest of this area over here together with the uptrend channel resistance. So for the fourth quarter, we do have, in terms of technicals, we could see the S&P 500 head towards the 7,000 to 7,300 area. And if you take the midpoint at 7,150, compared to the current last close yesterday, we could see about 6% upside from the current levels. So all in all, for the Nasdaq as well as S&P, we think that it could continue to trend higher into the fourth quarter based on the technicals. And then last but not least, we also have our Magnificent 7 pick based on the technicals. And for the fourth quarter, we have chosen NVIDIA. So for this slide, I will go through why we think NVIDIA is a good pick in terms of technicals going into the fourth quarter. So with overall, what's currently happening for NVIDIA is there was a breakout of this consolidation that's taken place since August. But I'll go through the chart, what has happened since start of this year. So the price actually recovered from the Liberation Day sell-off in April. Afterwards, we have seen a very steady uptrend since May, where price was trading in this uptrend channel until about August. Then afterwards, it's started to flatten out and trade this sideways range, mainly between about $171 to about $184. And then something notable that in terms of the price action was at the start of September, where price actually, there was an attempted breakdown of this range support level at $171. However, it only lasted about a few trading sessions, and we see a price managed to recover back up. And then subsequently, when it did a retest of this $171 again back in September, the price managed to hold it back. So this is actually a bearish trap that is formed over here, which could trap the short sellers that have attempted to short below $171. And then some further positive price action that followed afterwards was that price managed to break out this short-term trendline resistance and stayed at $176 when price did a retest. And then going into the start of this month, there was also a breakout of this $184 level to reach a new all-time highs. And last but not least, the most recent price action also showed that the prior resistance at $184 has managed to hold as support. And as of now, pre-market, I think we are currently seeing there's some positive gains as well. So overall, the chart looks very nice. And we think that with this breakout of this current consolidation taking place along with the bearish trap that occurred in September, we do see NVIDIA possibly heading higher towards a potential target of about $210. This $210 target is derived by taking this range over here, the previous range at 171 to 184, that's about $13 range. And then we project it about 2 times upwards to reach this $210 target. So that will represent about 11% upside from the yesterday's last close. Yeah, so that's all for the technicals. And this slide actually shows our US stock coverage in terms of the companies, our recommendations, as well as our target prices. So I'll just pause over here for a moment for all of you to just look through the coverage that we have. Yeah, and this will be our last slide. So this is our conclusion. So to conclude today's session, we have 3 key points. So first one is that we saw the Mag 7 stocks actually recovered strongly in the third quarter, and 6 out of the 7 actually outperformed. And our second point is that AI is still driving the headlines and continue to drive growth as well as in terms of revenue as well as margin growth. And the continued capex growth is expected to benefit the chip makers. And the last point is that fourth quarter guidance issue is positive, and we do expect the Mag 7 to end the year on a high. So that's all for our presentation today. And this slide is for the Q&A, where you can scan the QR code to ask any questions. Or you can also submit your questions in the Q&A by typing your questions in the Q&A tab in the Zoom. Yeah.
Hey, thanks, Zane. Yeah, so I will be trying to moderate the Q&A session. I think we'll just go with the questions that are the most upvote. So I think the first one being, amongst all the Max 7 stocks, which two stocks potentially can have the highest upside within the next 6 to 12 months? And I guess based on our calls, you can see that Amazon has I think it's the only one has a buy call. And the next highest one, I guess, would be Nvidia. So maybe I'll just hand it over to Helena, who can talk more about Amazon. And I think it's related to also another question on Amazon, which is asking, will the tariffs affect Amazon's operating margin? Yeah, so Helena, over to you for this question.
Thanks, Gan. I guess I'll start answering about the operating margin. So yes, most definitely it will pressure the operating margin because higher tariff, it could drive up their sourcing costs. And then it's really a question of whether they want to pass the cost to their consumers or they want to absorb it. So from what we see right now, a lot of the e-commerce players, after the tariff thing come into play, they've actually changed their delivery policy. So they either cancel free delivery or they try to up the minimum spending for free delivery. So Amazon is one of the very few companies they actually didn't change their delivery policy at all. So it kind of shows that they're pretty determined to absorb the cost, sure the price does go up. And so when the tariff does hit, we're almost pretty sure that their margin are going to be compressed. So we estimate a margin to shrink by about 80 BPS. But with that being said, we still believe that Amazon can still outperform in a high tariff environment for mainly two reasons. The first is because of its scale and very diversified seller base. So that kind of provides them with more resilience because they have greater bargaining power when they try to bargain the cost from their sourcers. They also have flexibility to shift the sourcing to tariff favorable countries like Vietnam or Mexico. And because they have so many wide range of different sellers, so they're pretty sure there are certain sellers who are willing to absorb the cost to maintain their market share. So that kind of helps cushion their consumer price impact a little bit. And the second is because now they have a strategic focus to move more onto affordable essentials like daily necessities because their delivery speed up. So you can buy a lot of daily essentials on the platform. So now because of their strategic focus shift, it kind of positions them better in case when there's the price increase. So it favors more to price sensitive shoppers. And I guess at the end of the day, because when tariff does hit, it hits a lot of the players equally. So everyone would be experiencing and increasing the price. So at the end of the day, if the price is increased everywhere in all different kind of platform, which is the platform you're going to choose. So probably you're still going to choose Amazon because they have a wide range, they have a bigger scale, and they have been doing so much on improving their delivery fee, which is why we think even though there's going to be some margin compression in its retail sector, we still believe Amazon is going to be the e-commerce retailers. With regard to AWS, like I mentioned already, because right now cloud industry as a whole, we're still pretty optimistic on it because it's still at a very beginning stage. So it's not something like a bubble. It's the cloud demand is very tangible. It's there. We're seeing it. So now 85%, more than 85% of the IT spend is still on-premise. So eventually all these on-premise data are going to be shifted onto cloud. So that's still ongoing. And right now there's only 3 major players in the cloud industry. And we're not really seeing them fighting for market share yet because the industry is so not saturated right now. So all the 3 companies are seeing very, very strong growth, very steady growth. The backlog is increasing a lot, and all of them are doubling down on spending on their capex in order to keep up with the demand. So for them, it's not really a problem of whether they're overspending. It's really a problem of whether they worry that they don't spend enough, so they're not going to be able to keep up with the race. So we still see a lot of growth prospect on that, which is why overall we're pretty positive on both sectors, which is why we maintain a buy recommendation. So I hope that answers your question. I'll pass my time to my colleagues. Thank you.
Yeah, thanks. Yeah, I see quite a few questions on the US banks. Right. So let me just answer this question. I think there's a few here, but it's asking, of all the US bank stocks, which should you accumulate? And also, with the earnings coming next week, what are the expectations as well for the US banks, and which am I most positive about? Yeah. So I'll just answer these two together. I would say the biggest, the ones that we're most positive about would be the larger banks. So you're looking at banks like JP Morgan, Bank of America, where they are more diversified. They also have a larger. They have more strength in investment banking and in trading. So these are the banks that we are more positive about. I guess in terms of more concern, we'll be looking at the smaller banks. Those are banks that have very high exposure in the CRE, and also I guess amongst the three that we cover, I would say Wells Fargo would be the one that we are watching out the most amongst these three banks, mainly because of a bit of the margin pressure, as well as some of them provisions may not be as stable as the other two. So in terms of the most positive would be JP Morgan. Okay, let me move on to the next question. I guess yeah, there's one here, asking, do you see a short-term pullback in October or November for the US stock market? So this is the most, I think, upvoted one now. Fundamentally wise, there could be a short pullback, but with rate cuts expected and coming in, and now that I've shown that that the Max 7 concentration is actually increasing, the tech stocks could continue to trend upwards, right? And that will provide the buffer, and the pivot for the US stock market. And also the bank stocks are also doing very well because rate cuts would mean higher loans growth as well as lowered funding costs. Maybe I will get Zane to do a quick TA for this. If he could do that, that would be maybe a bit more useful. Yeah, Zane, could you possibly do that?
Okay, thanks, Glenn. Let me just try to change my screen to the charts. Yeah, just give me a quick sec. Okay, yeah. So regarding the question on whether we could possibly see a pullback in the remaining months, I do agree with Glenn that we could possibly see in terms of pullback. Mainly because if you look at the broad-based index for S&P, so I flashed out some of the more medium to long-term moving averages. So that's the 50, 100 as well as the 200-day moving averages. So we took a look at the 50-day moving average, which is this bit of a yellow line over here. We haven't seen a retest of this line quite at all, actually, since the start of this year when the market was a bit more sideways. So I think this is a very strong market, strong trend that we're currently seeing, and there hasn't been a very sharp pullback of maybe around 5% or something like that. And it's been over 100 days since we have a daily 2% drop in terms of the index as well. So I think possibly we could see a pullback if it continues to stay quite far away from these longer term moving averages. Also because if you look in terms of the previous trends, the uptrends that we've seen, for example, in last year, 2024, there's been multiple retests along the bit of a midterm moving averages along the way, and going to 2023 as well. And also a bit earlier on, if you look at 2021, a very nice trending market, there's also been retests of this 50 to 100-day moving averages along the way. Yeah, so I think there could possibly be a pullback along the way if there's some factors that come to play that affect the index. But I think overall, if such opportunities occur, that could be represent an attractive entry point because the uptrend is still intact. Yeah, so that's my take on the question. Thanks. I'll hand over time back to my colleagues. Yeah.
Thanks, Zane, for that. Yeah. We'll jump straight to the next question here. Any concerns? This is for Fahmi, I guess. Asking any concerns about Oracle lowered margins and making losses.
Hey, thanks, Glenn. So for that, I think there could be some concerns on Oracle's lowered margin. And when you talk about recent loss, because the company is going to make heavy investment in the capital expenditure in order to cater to their cloud infrastructure high demand, because they need to compete with the other hyperscalers such as AWS, and then you got Microsoft, you got Google Cloud, right? They are already far ahead compared to Oracle. Oracle is just starting. So for them to catch up, then they need to spend out more capex. So that would probably contract some of their margin, especially that. And Oracle plan, you look at it last year, Oracle doubled its capex year over year. They significantly ramp up their infrastructure spending. While this may lead to some cash flow contractions over the next 2 years, we expect it to pay off in the long run. That said, we don't expect Oracle to report losses in the near term. In fact, the company has guided for higher profit going forward. More importantly, when you look at Oracle, right, other than its margin and its better earnings, Oracle is focusing on long-term gains, and we will probably see some short-term volatility. Its cloud infrastructure segment is expected to grow 70% year over year, and they have strong revenue visibility for the next 5 years. Not many companies could provide that. They already have pipeline already in place, many of the demands, just wait for them to supply. So, and just a matter of whether they could monetize these high capex, this high RPO. So the quicker they could monetize these high RPO, you could probably see higher revenue and boost their profits, and could probably move up the share price. So we believe Oracle still have room to grow. Its cloud RPO backlog is actually 5.5 times of its revenue and half the combined RPO of the other leading hyperscalers. That's just to go how good they are compared to the other hyperscalers. So this signals strong committed demand, despite them being relatively small compared to the other hyperscalers. Yet the capex that they are spending is actually smaller compared to the hyperscalers. They are 2.7 times actually smaller compared to the combined hyperscaler spending. But if you look about it, that we might actually see them ramping up more capex actually in the future, because they have super high RPO, and for them to cater to that is only makes sense for them to ramp up the capex, because if not, they cannot monetize these high RPO. Thank you.
Yeah, thanks, Fahmi. Give you a short break before you can prepare for the next one, which will be the Adobe one. But I'll answer another question here first. It's asking, I think it's a comparison between the dot-com bubble burst and now this AI. I mean, you're assuming that it's an AI bubble. So the question is, from 2000 to 2002, the market basically crashed during the dot-com bubble burst. And so he's asking, what do you think about AI burst? And any miss in coming quarter reports or political crisis will cause the big drop within a day. And what are our thoughts? Yeah, that's a good question. Yeah, but if you want to compare between what happened in 2000s and now, it's quite different. Firstly, the valuations were a bit out of whack. If you look at in the 2000, right, it was almost 60 or 70 times. Now we're looking, around below 30 times. And also a lot of the companies back then, right, during the dot-com era, a lot of them were unprofitable. But if you look at the AI players now, and the hyperscalers, they are actually all profitable companies with a good business model, right? You're talking about big names in the Mac 7. And so it's quite different. And of course, we could see some volatility. I think the most important thing we'll be looking at would be the capex spending. If that goes down, then of course it would cause a dip in the share prices for some of these hyperscalers, right? But it's really about the competition, within each of these hyperscalers, right? If you don't spend as much as the person next to you or the company next to you, then you'll be losing out. So we see them continuously spending on par with each other. If one increases their capex spending, usually the rest will also follow suit in order not to lose out. So it's really a game of like chicken, where you try not to lose out to your competitor, right? Because if you need to spend just as much in order to basically just spend just as much in order to keep going in the race, right? So that's, I guess, the long story short. Yeah, so it's a very different story. So I don't think there'll be such a burst. There could be a slowdown when the capex spending slows, and we could see slight correction in the share prices. But the good thing and the good news is that all these companies do have good business models and solid business models and fundamentals. So that could help to soften some of that if really the capex slows down greatly. Yeah, now going back to the other questions here, there are quite a few questions on Adobe. So I guess this could possibly be our last question because of the time. So a lot of Adobe questions, asking what is the view on Adobe, how about its competitiveness, and also, I guess going into Adobe and Salesforce, why is it a buy, and whether or not it's the competition, I guess, against Figma, who is now in the news as well. Yep. So hand it over to you, Fahmi, for Adobe and Salesforce.
Thank you, Glenn. Looking at Adobe, I think why the share price keep dropping is because market is expecting faster AI monetization, whereas for Adobe, what they are doing right now, I mentioned that they are focusing more on the increasing usage of their product first instead of monetize their products. But they do already integrate many of their AI into many of their products, their Firefly. So as more market is expecting higher AI monetization, that's probably why when these earnings came out, then they didn't really reflect AI revenue particular section. That's why market disappointed. Then the price went down. But we do think actually AI revenue is actually still in the early stage, because when you look at it, Adobe's AI revenue is actually quite small. The contribution is only 1% of the total revenues. It's not that big, because our focus is actually on the main products. We like Adobe because of the creative products, which is some of the products that is quite well known, such as Photoshop, Illustrator. They remain the gold standard of their industry. Many people are using it, and many enterprises are using it. And they have a very wide ecosystem that when you look at it, even whenever people want to buy new creative software or product, it makes more sense for them to buy a new attachment product from Adobe instead of buying a new from another competitors, because they already integrated into ecosystem, and they are it make their work easier to just, for example, transfer the work one to another. But looking at AI, right, talking about AI, their AI Firefly is actually gaining momentum in terms of adoptions. They reported that Firefly recently generated about 12 billion in generated asset, and their traffic for Firefly is already increasing 30% quarter over quarter. But just that they are not really focusing on monetization. So market disappointed on the AI monetization, but we still like them because of their strong product ecosystem and their stickiness. So in the near term, really that accelerating, but still we do still like Adobe because of that. And in terms of competition, Adobe is focusing more on the enterprises because they have very broad range of products, and they cater more to the enterprises compared to the other competitors like Figma or even Canva, right? Canva is really small relatively, and they are actually more focusing on the casual users, and their functions is quite limited compared to what Adobe can offer. So Adobe target more on the enterprises, clients, and creative professionals who need more advanced tool and more complicated product and software. While as for Canva, their products is a bit more limited in that sense. So we do think that Adobe could retain most of the enterprises. We don't see that you see these enterprises left Adobe and go to the other software provider, because Adobe have a lot of functions, and these new and small enterprises don't really offer a lot of functions compared to Adobe. So yeah, that is all from me. Thank you for listening. Back to you, Glenn, I think.
Yeah, thanks, Fahmi. Yeah, so we have actually overrun already. Yeah, I think we're 3 minutes over. So I guess we have to end it here. Apologize if we can't answer all of your questions, but do join our community on Poems Mobile Tree, and we will put your question there, and we'll try to get back to you, on the community. And also apologize also for some of the audio, I think, issues there earlier on. But thanks again, everyone, for taking the time during your evening to join us for our webinar. And also hope you gain some insights into the fourth quarter outlook. Yeah, so I think that's all we have for today. And yeah, we would like to sign off here. Thank you.
Thank you, everyone. Thank you, team. Please kindly fill in our feedback form so you can improve your experience with us in the future. And this webinar will be uploaded in our PhillipCapital YouTube channel. Once again, thank you for joining, and we hope to see you again. Stay tuned, take care, and have a nice day.